Hello, everyone. Thank you for joining us today. I'm Marche, the webinar director at Advice Chaser. We're so glad you're here. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you this educational presentation. Just a note, attendees are muted, but we do encourage you to ask questions using the chat box, and our presenter will answer those queries during or after the webinar today as appropriate during our question and answer portion. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your phone number or email address as well. If we can't get to that question during our presentation, we'll go ahead and make sure that someone reaches out to you after today's event. We want this experience to be as educational as possible. So once again, please don't hesitate to ask for clarification or expansion of the material. That is what we're here for. Well, I'd love to introduce you to today's presenter. Ethan Brown is a partner and portfolio manager with Cox Capital Management. Ethan specializes in portfolio optimization techniques and quantitative strategies. His primary responsibilities include equity and fixed income research, portfolio management, and trading. He has a bachelor's degree in political science from the University of Michigan and an MBA from the University of Massachusetts at Lowell. And he also is a certified financial planning professional. He currently runs the internship program at Cox Capital Management and is a former national champion triathlete and a 2012 Olympic trials qualifier. He sits on the board of directors of the Drake Academy of Excellence as well. And Ethan, I'm going to go ahead and turn the time over to you. And so excited for this presentation, and the floor is now yours.
All right, excellent. Well, thank you, Marche, and thank you to Advice Chaser for having me for this webinar. I'll just reiterate again that I'm not here to market any product or service. I'm here for educational purposes only. And so today we're going to talk about money habits for millennials. And so I think we have a table of contents coming up in here. I'm passionate about financial education, and I think one of the big, failures in this country is that there's a lack of financial education out there. And so a lot of the different topic areas you're looking at right now, they're really critical for, achieving financial success and financial security. But unfortunately, it's kind of like you're just thrown to the wolves and have to figure out a lot of this on your own. Today, I'm hoping just to kind of touch on each of these areas, not go too much in depth on anything, but just give you some general kind of takeaways that you can come back to, and hopefully we'll have some good advice from this. Just in my kind of day-to-day job, I meet with a lot of younger folks, and we talk about this stuff, and we talk about how to set up their lives to start saving and protecting themselves going forward. It's a lot of them are in the same position I'm sure many of you are, where they don't have a lot of knowledge in this area. And, it's a lot of kids of my current clients, maybe in their 60s and 70s. And they, for some reason, they don't like to listen to their parents, but they'll listen to me, someone who's a bit closer to their age range. So I hope you can, get some good takeaways from this. So as I said, I'm going to try to keep things pretty brief and high level. You could probably go into a full presentation for every topic that I'm going to talk about today, but I'd like to keep it to trying to present what's widely considered like an industry best practice for every main area. There's a lot of complex financial strategies out there, so I'm sure that you could probably debate me on everything that I'm going to say. But I think if you were just to take a high-level advice for each of these categories, you'll be on good stead to do that. So pretty much all the topics that I talk about either fall into one of two major categories. So the first would be on the reducing risk front. So these are the insurance planning, estate planning, just trying to protect against disaster and make sure that, in the event of a disaster, that you're well covered, and that you have a process and a plan. And then in the other bucket would be accelerating your net worth. And that kind of relates to your saving habits, your investing habits, how much you're contributing to retirement, and some of that stuff. And so again, I hope you can come away from this presentation with a few kind of actionable items that you can carry out and will help and improve your financial life.
Yes, so the first topic that we have here is on the asset protection side of things, and this has to do with estate planning. I think when most people think of estate planning, they think of like some family worth millions and millions of dollars that are trying to protect their wealth. But the reality is that everybody, if you've got kind of, if you have basic assets, if you've got kids or people that depend on you, you probably want to have just a really simple estate plan in place. So typically there are three things that you want to have with that estate plan. The first would be just a simple will, which is something that very simply allows you to, it gives instruction on how your assets are distributed in the event of an unexpected death. The second one is a durable power of attorney. And so this would give somebody else the power to make financial decisions on your behalf in the event that you become incapacitated. So if you go into a coma, you need somebody to pay your bills, pay your mortgage, all that stuff. You definitely want to have a durable power of attorney in place. And the third one is a healthcare proxy. And this gives somebody else the power to make healthcare decisions on your behalf. Everybody, or most people, have like wishes at end of life in terms of, if you're in a coma, do you want someone to pull the plug or try every treatment available? And so you communicate your wishes to this person. You'll have a healthcare proxy, then probably a backup healthcare proxy. And so they could make healthcare decisions on your behalf. And I think there's some horror stories out there where somebody did not have this in place, and their spouse couldn't even be in the same room as them when they're in a really, really tough medical condition or medical state. So those are the three things you want to have in place to just protect yourself and allow for kind of a smooth transfer in the events that things really kind of take a turn for the worse. The other reason you want to have these in place is you essentially want to try to avoid probate as much as possible. So by having beneficiaries on all your accounts, these would be savings, checkings, investment accounts, 401ks. There's a place where you can add in a beneficiary. Who do you want to have your assets on in the event of your death? And you want to look at those fairly frequently, because if you go through a big life event, you get married, divorced, you certainly probably want to be changing your account beneficiaries in that case. But so having all your assets titled properly can to some degree help avoid probate. And so probate is a long public process where all your assets kind of go into court, and a judge has to decide who their rightful owner is. So if you don't have a lot of these things in place, it can more of your assets go into probate, and it's a time-consuming process. It's a very public process, so everything you have is posted in the newspaper, and people can see this. And it's expensive because you're hiring attorneys to do all this. So you can kind of minimize probate costs by having a simple will in place. And certainly the other two are critical just for protecting against disaster.
Okay, moving on.
Perfect. So this is the second area of what I would call the risk mitigation. And so this is being insured to some degree. So insurance is it's a big, complicated subject, and there's a lot of different opinions on it. But again, in the spirit of keeping it general, I would say for most younger folks working full time at the point where they're kind of just starting out and call it real life, and it's got a 401k, a house, and things like that, we generally recommend for that situation somebody to have term insurance. And so this is just life insurance that has a certain term on it. So the most typical one is about 30 years. And the rationale here is that term insurance is cheap, so it's affordable. And the reason you want to have that in place is essentially to cover three things in the event of a premature death. So if you have any outstanding debt, you want to have enough insurance to be able to pay that off. If you've got small kids and you have education plans for them, education is a major expense nowadays, so you'd want to have enough insurance to pay for their education. And then depending on the income that your spouse makes, you'd want to have some income replacement there. And so if you were the sole breadwinner and sole provider, then you probably want to be more insured on the term side, so that if something were to happen, your spouse has enough money to get by for a while before they can go back to work or just to live on permanently. And so there's aside from term, I think the other kind of big ones I hear about a lot are having whole life insurance, which essentially, just like the name sounds, it covers you for your entire life. There's disability insurance, which if you become disabled and can't work, then this would kick in. And then just in general, we have long-term care insurance that most people don't start thinking about until they're in their 50s, but that just gives you coverage in the event that you have to go into an assisted living facility or something like that and needed kind of more intense care. So, again, who is it appropriate for? I think that if you're younger, relatively in good health, and you have dependents at this point, or you have a mortgage, I think you probably should have some type of term insurance. Another strategy that's out there on the whole life side, some people advocate for buying a whole life insurance policy, and the value of that policy builds, and you can borrow against it at some point. That's a little bit more of a complex strategy, and it would be debatable if that's the right thing to do in terms of growing your net worth. What I will say is if you're somebody who is like extremely risk averse, the concept of investing in markets just scares you, and you keep all your money in cash, then maybe a whole life policy is something that would be appropriate, because it allows you to build some value and grow. It has a little bit of a guarantee in there as well, and it's insurance in case you pass away. So that's something to consider. But I think for most people, it's typically not super appropriate. On the disability insurance side of things, so I would say this becomes appropriate if, say you work a job that's dangerous, if you're on an oil rig for half the year or something like that, you're making a good income. If you have a family at home that kind of provides, or that not provides, but depends on that income, then you probably do want to have a disability policy. Now, you're in a dangerous profession, so it's going to be very expensive because the insurance companies know that you're in a dangerous profession. But that's a case where, in the event of disaster, if there's some probability that you could become injured or permanently injured, you just want to cover your bases there. And nowadays, there are really kind of cool financial planning software out there that allow us to really, I guess, hone in on the exact amount of insurance you need. So we can actually run scenarios, or like we might say, given here's what you spend in a given year, what's your income, what are your projected education costs down the road, and how much is your mortgage, and you can kind of back into how much is the right amount. There's some rule of thumbs, like some people say, you want to have term insurance worth 10 times your income. But again, I think every situation is dependent. So, if you did want to go that route, you would just want to consult with an insurance professional, preferably an independent insurance professional that, isn't kind of tied to selling one product that can kind of point you to where the best value is. But just to summarize quickly, lots of different kinds of insurance. I think term is probably most appropriate for young people, and it should be enough to cover any mortgage or debt you have outstanding, education for kids, or replace lost income. And before we go on to the next one, so just, there's been a lot of abuses in the insurance world. Like I remember like seeing some of my friends that were sold like insurance or annuity products when they were in their 20s, and they have no income, they have got no assets, no dependents, no mortgage, and so having insurance there is completely not appropriate. I think the industry is rationalizing a little bit, so there's less and less of that kind of just salespeople with selling insurance products to get commissions. That's kind of being dialed back a bit. But I would just be skeptical in this area. You really want to work with somebody that has your best interests at heart, preferably what's called a fiduciary, as opposed to a broker. So the only difference there is that a broker gets a commission when they sell a product, and a fiduciary has to act in your best interests, and they just receive a fee for the service as opposed to a commission. All right, so getting into the area of kind of growing your net worth going forward, and this is my world. I'm more of an investment guy. I spend most of my time doing investment analysis, in addition to general financial planning. But so I think if you came into this webinar, you're likely a millennial, and so if you're healthy and you plan on living a long time, you probably have an investment time horizon that's 20 or 30 years, maybe even longer. And so your time horizon is one of the biggest factors in basically how aggressive you want to be in terms of investing your money. And so in general, I'll just start with this bullet point here. Your asset allocation, basically how much you have in stocks versus bonds, is what's going to be the main kind of driver of your returns over a long period of time. So just, if you don't know a whole lot about markets, stocks tend to be a little more risky, more volatile, but over time, they tend to do quite well. I think if you go back to 1920 or something like that, stocks have produced an average of something like 10% a year or something right in that ballpark. Bonds tend to be safer, a lot less volatile. They typically have a lower risk of loss in most market environments. They're certainly not going to return 10% on a long-term basis, most likely, but they do provide kind of safety and stability in a portfolio. So I would advocate, and this is what I tell the younger folks I work with, if you've got that 20 or 30 year horizon, I think it's appropriate to have like 90 or 100% of a stock allocation in your investment accounts. And these are investments that are basically geared towards getting you to retirement. I think if you say, I'm going to buy a house in 5 years, don't put all that money in the stock market, because that's not a long enough time horizon where if we do get a big market crash, it may not come back within 5 years. But, I think it's a lot more likely to come back within 20 or 30 years. So you'd want to have kind of a higher bond allocation if you have money that's kind of earmarked towards more of a shorter term or medium term time horizon. And then, so I'm saying you probably want to be a little bit aggressive, invest in the stock market. And so there's a big debate, which is called the passive versus active debate. And so passive investing is basically, just buying the stock market as a whole in what's called an index fund. And so an example of this would be, the S&P 500. This represents, the 500 largest companies in the U.S. And so an S&P 500 index fund, it might hold Apple at 5%, Microsoft at 4%, Google at 4%, whatever the top names are. And so you're just owning the market as a whole. Whereas in an active investment, you might be buying a fund where the portfolio manager, the person managing the fund, has a view where they think their view can outperform a passive investment. So maybe they don't like Microsoft. So instead of having 5% Apple, 4% Microsoft, they have 5% Apple, 4% Facebook or something else. They're making a conscious decision to deviate, from the market weight. And they hope by making that decision, they can outperform the markets basically. Well, if you look back on lots and lots of data, it's very rare to have active managers consistently outperform the market. And one downside to investing in active funds, whether they're mutual funds or ETFs, is that they tend to have higher costs involved. So really, when it comes to investing in like large cap US companies, I think passive investing is a pretty safe bet. Now, that said, I think when you get into kind of smaller stocks and sometimes international stocks, you do have more active managers that have outperformed the indexes more consistently. So it depends on what market you're looking at. I think the US large cap market is like the most competitive stock market on earth. It has the most people paying attention to it. So it's really hard to outperform the indexes. But then when you kind of get into some smaller companies that have less coverage, some international markets have a little bit less coverage as well, there are more active managers that have done well. But it's starting as a base case, I would say use passive index funds because they're low cost, they're well diversified, and those are the two big variables that if you can be diversified and minimize your costs, you'll do very well over time, most likely. So on the active side, I would say you want to only invest on the active side if you've really done your research, you know what you're doing, and you've basically have done due diligence on a fund where you have a strong the active manager has a strong probability of success based on their history. But even then, I think the safe bet is to go passive. And I think for folks that do buy individual stocks, my advice there would just be don't take too much of a concentrated position. Again, this goes back to always wanting to be diversified because you really just don't know what the future has in hold. I think a few weeks ago, Facebook stock was down like 23% in a day. And it's just amazing that you can get these really big price swings. So it's just kind of a cautionary word that you'd want to err on the side of having, maybe instead of having one 10% position in your portfolio, have 5 2% positions and really just be diversified because that's going to minimize your chances of screwing up or making a mistake.
So I have a couple of vocabulary clarifications to
Sure.
people who may not know kind of these terms in the investment world. Can you explain exactly what equities means first?
Sure. Equity just refers to stocks. So I use kind of stock market and equity market interchangeably.
And then I know an index fund is a type of mutual fund. So maybe if you can explain what mutual funds are really quick too.
Sure. Yeah. An index fund, so like I said, it's kind of mimicking like an index, like the S&P 500 index. And so when I talk about mutual funds, these would be this concept of an active fund where they have weights that might be different from the index because that portfolio manager thinks that they have an edge and they can outperform. And so in general, when I say indexing, I mean passive. When I'm talking about mutual funds, I'm talking about active.
All right. Thank you so much.
Sure. And just one thing to mention there too, there's a new type of fund out there it's really popular in retirement accounts. It's known as a life cycle fund. And so what this does is it automatically adjusts that asset allocation as you get older. Because certainly as you get closer to retirement, you want to have more safe securities like bonds in your portfolio. So what this does, I mean, if you invested in it right now, it might have you at close to 100% stock allocation. But as the years go on, 5, 10, 20 years down the road, it's going to add more bonds to your portfolio, and it's going to do this automatically. So it's kind of a set it and forget it type of strategy, which is kind of nice. They're typically done with low cost index funds, so it's good from a cost perspective as well. So that's something to consider if you've got 401ks or retirement funds out there. All right, so we're going to talk about speculation right now. And so one of the things, I hear, and I think some people say a lot, is like, you can afford to take risks when you're young. And that is true in the sense that if you take a risk, if you invest $10,000 in a risky investment and you lose it, you're young, so you have a long time to kind of work and earn that money back. And, that's not true when you're older and in retirement and you don't really have an income stream anymore. You can't afford to lose it. But the kind of contradiction I see here is that there's a massive opportunity cost to making a speculative investment and losing money when you're young. Because if you were to take $10,000 and you invest it in some new cryptocurrency that's out there, and you lose 80% of it, what you're giving up is basically probably investing in the stock market that has a long history of positive returns, and so over time, that 10,000 might grow to 20, to 40, to 80. And so if you were to take the opportunity cost of what you gave up by making that speculative investment, it really is pretty significant. So, I mean, at least at my firm, we really discourage folks to speculate. And if they do, we say, make sure that it's just 1% of your net worth or nothing significant. And I'll also clarify just, so there's speculation, and then there's investing. So if you speculate, you buy something, whether it's a stock or a cryptocurrency, an NFT, not because you really believe in that asset a whole lot. You just think that at some point other people are going to buy it from you for more. So you could care less what you're buying. You just think that it's going to go up. Whereas investing, I think, is more doing fundamental research. You analyze the company, you know that their cash flows are growing every year, they're paying a higher dividend, it has a reasonable valuation, so you think that's probably a good investment. If I hold on for a few years, it should be worth more. And I think over the past 2 years, I think speculation has just kind of come roaring into the markets from the pandemic. People were quarantined at home and bored, and they couldn't go to the casinos, so they started gambling in the stock market to some degree. So we saw a lot of crazy price behavior in markets where companies that weren't profitable were just doing extremely well all of a sudden. You had cryptocurrencies take off. And I would really just caution people against that. I think, when you're looking at a 20 or 30-year horizon, you don't have to take risks. It's slow and steady wins the race. And on this slide that I have here, I'm introducing this concept that's called value at risk. And it basically just tries to measure how much you could lose in a very short amount of time, in this case, 1 day, by investing in different asset classes. And so you can kind of see on this chart here, the first 3 categories are all bonds. The value at risk is relatively low, especially in short-term bonds. It's 0.3%. So the probability for loss is a lot lower in those asset classes. And what I did here, by the way, I went back 3 years, which isn't even a robust time frame, but I just took the average of the worst 10 days in every particular asset class over the past 3 years. So if I was going to do a more formal study, I'd want a longer time horizon, but this is really just to illustrate these concepts on a high-level basis. So after the 3 categories with bonds, you kind of see a step up in risk as you get into the stock market. You can see the S&P 500 there has about an 8% value at risk in 1 day. And then small cap and emerging market stocks are a little bit higher than that. And that's fairly typical. You have to take some risk in order to kind of grow your money over longer periods of time. But then when you kind of step up into the cryptocurrency world, it's another really big step up in risk. And so I'm just using a Bitcoin exchange traded fund as a proxy for the price of Bitcoin. And I'll also say that, I mean, Bitcoin is probably one of the most stable cryptocurrencies out there. I think when you really get into some of these smaller ones, the value at risk is a lot higher. It's probably 20, 30, 35% in a day. So, I mean, if over the course of your lifetime, you can just avoid big losses, you know, you'll be doing yourself a huge favor. And especially what happens to people is after they experience a big loss, it kind of messes with you from a behavioral finance standpoint, and people do crazy things like they sell at market lows. And then once you do that, you know, that value is kind of permanently destroyed. So it's just important to try to avoid really big losses, have a diversified portfolio. If you do want to speculate, make sure it's just with an teensy percentage of your overall net worth, and don't put yourself at risk. Okay, so kind of turning to the topic of saving and planning for retirement, I think this is really huge here. As you think about saving money, you know, there's what I like to call a tax efficient order in how you do things. You know, so and this is with the context of you only want to be investing if you have an emergency fund built up. And we'll talk more about emergency funds in a little bit, and I'll give you some guidelines on how much you want to have there. But so essentially, if you are kind of putting money, if you have excess cash on the side that you want to invest or you want to do something with to kind of accelerate your net worth down the road, probably the most efficient thing you can do is to put it into a company-sponsored 401k plan or any sort of company-sponsored retirement plan. Basically, if you make $50,000 a year and you put $10,000 into your retirement, you're only taxed on $40,000. So not only did you just put $10,000 into your retirement account, you just saved on whatever your taxes would have been on that incremental $10,000. You know, so you really get a double benefit by contributing to your retirement plan at work. And a lot of times employers will have a match, so maybe they'll match up to 4% of what you put into your retirement. And I mean, that's free money, so you can't beat that. Along those lines, there's something else called an HSA, which is a health savings account. And if you have a high deductible health plan, which I believe, you know, I forget what the exact cutoff is in terms of what the premiums are. But if you have access to an HSA, you have that same benefit of essentially for every dollar you put into the HSA is $1 less that you'll have to put in taxes. You know, so company-sponsored plan or HSA, if available to you, you certainly want to try to put as much as you possibly can into, you know, before kind of saving in other areas. You know, so say you max those things out. Then the next thing on the list would be to contribute to a Roth IRA. And so this is with post-tax money. So you have 50 grand, you know, you put 10 grand into retirement, but you still have some excess money left over after all your living expenses that's been taxed on. So it's called after-tax dollars. And if you are below a certain income threshold, I think it's like 107,000 for an individual, like 190 for a couple, then you have access to a Roth IRA. Everything you put into a Roth IRA grows tax-free. You know, so any dividends, interest, capital gains in there, you pay zero taxes on. And then when you take the money out, that's also tax-free. So if you max out, you know, whatever benefits you have at work, and then you still have excess cash left over you want to do something with, a Roth IRA is definitely the thing to do. Or if you're over the income threshold for something like that, then you go down to the third step, which would be a taxable investment account. And so this is just like opening a brokerage account on, you know, Fidelity or Schwab or Robinhood or something like that, and starting to systematically invest there. So those are the three things that I would do in that order when you're thinking about saving and planning for retirement. That's going to give you the best bang for your buck. And with a lot of this stuff, it's like you can really automate it. So you just set your paycheck up to go directly in. And if you know that you can afford to save an extra, $250 a month or whatever, I would automate that into another investment account. But that's the order that I would recommend. And I think if you do that over a long period of time, it certainly adds up.
Can you talk a little bit about people who don't have access to like a company sponsored retirement account? Let's say you're an independent contractor or you're a good gig worker, something like that.
Sure. Yeah. So yeah, that's a good point. Not everybody, works for a, corporate company that would have a retirement plan set up. If that's the case, anybody can go set up what's called a traditional IRA, and you can put, I think it's $7,000 per year into a traditional IRA, and you'll get that same benefit of whatever you put into it. It reduces, it reduces what you're taxed on essentially. So you get that double benefit there. If you're self-employed, you can set up what's called a SEP or a self-employed plan. And it's the same deal there, that it allows you to put money away pre-tax. So you get to build your retirement while lowering your current tax burden. So traditional IRA or self-employed IRA, depending on your situation, are two options if you don't have access to a company-sponsored plan.
And am I correct in thinking that most financial advisors would be able to help guide you where to set those up?
Yeah. I mean, most financial advisors would. I think all the main big brokerage houses out there, like a Fidelity or Schwab, they allow you to set up these accounts, and they service the accounts and everything like that. So it's certainly, I think it's pretty common. So any financial advisor should be able to help with something like that. So the next topic is saving and planning for future education. And, this is, in this country, at least, it's a massive expense. Education has just skyrocketed. It's increased much faster than inflation has over the years. But there are some kind of tax benefits you can get by opening what's called a 529 account. And so this is a tax deferred education account. So it's after-tax dollars that go into something like this, but the cash or money will be put into investments that will grow tax-free, and it's tax-free when you take it out, as long as it's spent on qualified education expenses like tuition, housing, and things like that. The limits for something like this are $16,000 per parent. So you could theoretically, if you're married and have a kid, you could put up to $32,000 per year into an account like this. There is an option out there, what's known as super funding a 529, and that allows you to put 5 years of contributions in 1 year. And so you'd want to do that if you have a lot of cash saved up. Maybe you didn't start a 529 account, but you have a teenager that might be in college in like 4 or 5 years, and you want to get all the money into the account now to give it like 4 years of tax-free growth, as opposed to just doing the $32,000 per year. So that just takes advantage of maximizing the time horizon that you can get the tax advantage growth there. And on 529s, I mean, there are limitations. So these are education-focused accounts, and like I mentioned, that they have to be spent on educational expenses in order for you to receive all the benefits. And so if you don't spend it on education, then there will be penalties for taking it out. And so I'm seeing more and more people, as the cost of education go up, the return on investment of education goes down. So some folks, when they're thinking about their kids' future, they don't want to put it into a 529. So they say, well, what if I want my son or daughter to start a business or travel or do something else to gain life experience? And so in that case, you wouldn't want to use a 529 because it does have some restrictions on the uses there. So it's all dependent on what your goals are, but it is still a good savings mechanism that, gives you some advantages. And if you start over an 18-year time horizon, I think those benefits really add up. All right, and so those are the main subjects that we got through. What time is it? And so I have a few other just financial planning tips in here. I don't want to take up too much time, but so in general, I would say for most people, you want to have an emergency fund that's equal to about 6 months worth of expenses. So that's a base. So if you have a dual income household, you both have very secure jobs, I would say you can probably go down to having 3 months of living expenses and savings. Whereas if you're a single income household, you have slightly unpredictable income, anything that involves more uncertainty there, you'd probably want to have closer to a year built up in an emergency fund, especially if you did not have a high level of job security. So 6 months is it's a real general guideline, and I think it's going to apply based on a number of other factors as well. But for most folks, I would say 3 to 6 months if you're in a dual income household is what most people do. Along with that, again, you wouldn't want to be investing and putting money into markets, into the stock market or to other investment accounts until you do have an emergency fund built up. I mean, the statistics on this are staggering about like how many Americans could not afford, an added like $400 expense if their car broke down. They'd have to take out a high interest loan to pay it off. And you just really don't want to be in a position where, you have to make a bad financial decision because you don't have a savings fund built up. So this is like rule number 1 in financial planning, is that you want that emergency fund. So beyond that, I mean, when you think about kind of starting life and having a house and a mortgage and things like that, there is a general rule, it's called the 28% rule, is that you don't want to be spending more than 28% of your gross income, so income before taxes, on housing costs. And in the housing cost bucket, there's 4 things. It would be principal, interest, property taxes, and home insurance. And so I have an example coming up to show kind of what that looks like. But in general, that's the 28% rule. And then on top of that, there's a 36% rule where you don't want more than 36% of your gross income to be going on your mortgage plus any other consumer debt. Just in general, I mean, you really want to avoid credit card debt. I think that's probably a no-brainer for everybody, but the interest rates are so high that it's almost never a good idea to do it. I think there's a lot of there's debate on debt, whether debt is good or bad. And I honestly think debt, when used properly and reasonably, it's a good thing because it allows you to accelerate your net worth, especially with buying a house. I mean, if you can put 20% down and finance the other 80%, you're using a tremendous amount of debt or leverage there. But as your house price appreciates, the equity that you have in the house goes up really, really quickly. Like just for example, if you put $100,000 down to buy a house that's $500,000, and that house appreciates, it goes from 500,000 and it's worth 510, 6 months or a year down the road, your equity went from 100 to 110, so it increased 10%. So it's only a 2.5% move on how big the house went up. But using debt, you kind of magnify the returns you can get on the equity that you have in it. So it's not a bad thing as long as your income supports it, and as long as you're buying an asset that should appreciate. The bad thing about credit card debt and consumer debt a lot of time is you're buying things that depreciate in value. So in those cases, I'm a lot more hesitant to use debt. All right, so just continue from that example, what this 28% rule means in terms of kind of working backwards to figure out how much of a house you can afford. So say you're in a household, the gross income is $120,000 per year. That comes out to $10K per month. So we multiply 28% by that $10K, so you get $2,800. So that's your mortgage amount that you can afford, and so that, again, it's included. Your principal, interest, insurance, and taxes are all rolled into that $2,800 monthly payment. And so just kind of working backwards, if you assume that there was a 20% down payment, then this would correspond to a $470,000 house. So you'd put $94,000 down, that's 20%. You'd finance the rest with a mortgage. Now that comes out to $2,749 a month based on a 30-year mortgage at an interest rate of 4.25%, which is probably a little bit higher than rates are right now. So just a real life example of how you would back into it, because I think this is a question a lot of people have that are just starting out is, how big of a house can I afford? And it's tough out there. I mean, we all know that the housing market, the prices have just gone skyrocket crazy through the roof. And so it's really difficult. So you don't want to overextend yourself to go for something that might put you at financial risk down the road. So this is a good rule to abide by. And then another one of the big questions we always get is, if you do have excess savings or excess cash, what do you do with it? Do you pay off debt or do you put it in the market? And so we hear this a lot of times, and the answer is always it depends. And excuse me, I'll go over what it depends on. For one, it depends on like how much debt do you already have. I mean, if you're already levered up through the roof, you probably don't need any more debt, and you want to start paying it down. So if, on the other hand, if you have a reasonable level of debt, you have a high level of income that kind of supports continuing to save every month, and you'd probably want to invest it. So the big difference here is by paying off debt, you can you reduce your financial leverage, thereby reducing financial risk. By putting excess cash into the market and keeping debt, you accelerate your net worth. And so we just want to kind of look at all the factors between those two things to decide what's the best path for you. And to some degree, it depends on your personality. And if you're somebody that are you comfortable investing in the markets? Does debt make you uncomfortable and you just don't like having it? So these are the things where we kind of work with folks to determine how they feel about certain things, because you don't want to put somebody on a plan where they're investing in the markets when they really aren't comfortable doing that, because then they're likely to make a mistake and pull money out at the wrong time. So it goes back to how much debt do you have. If it's a reasonable level, I would say you can probably afford to invest it. Do you have that emergency fund set up where you have excess cash flow above and beyond that emergency fund? Then you can probably afford to invest it. Are you saving for something specific? So if you've got a big expense down the road, you're going to maybe buy another house, you have education expenses coming up, you're going to need a new car, something like that. If there's a specific item that you need to save money for, I would say just keep it in cash and don't try to invest it if you have a short time horizon, because that's just putting yourself at risk. And again, it's what's your attitude towards investing in the market or having debt, because how you feel about that is a big thing too. And you're not going to kind of follow a plan unless you really buy into it. And so those are the factors that you would look at, but that's a really common topic that we would discuss. I think right now with inflation at 7% or whatever it is, you want to have a little bit more debt, because if you're borrowing money at 3% when inflation is at 7%, it's kind of essentially eroding the value of that debt to some degree. And but inflation's a different topic altogether, but it's something to consider. And again, I just want to reiterate, I'm not making any recommendations here. Like everything that I'm talking about, it's situation dependent. Everybody has a different asset picture, a different net worth picture, different attitudes about different things, different family life. And so, the folks that we do financial plans for, we kind of look at the full picture. And when I'm saying things like, oh, I would do this, I wouldn't do this, I'm speaking in very generalities. I just don't want to get in any regulatory trouble here, so covering my bases. But so putting it all together, when one of the tough parts is, we went through a lot of different things today between estate planning, insurance, investing, how you save, and there's a lot of moving parts to this. So there is financial planning software out there that allows you to kind of put everything together in one big plan, run different scenarios. This little snapshot that I have on the screen here, this is a Monte Carlo summary. So this basically will spit out a probability of success, based on all the inputs we put into financial planning software. And we say, what's the likelihood that you will not run out of money? And this one, for example, has 100%, so that's really good. But as you're making financial decisions, I think there are some good tools out there. So this particular screenshot that I grabbed is from a program called eMoney Advisor. It's owned by Fidelity Investments. I think there are some free tools on Fidelity that you can kind of run through. Although I will say to kind of get a full eMoney package, it is cost prohibitive. It's something that you spend a few $1,000s per year on. But most financial advisors nowadays, they will have packages like this, and it's designed to really simplify everything. Now, in terms of, is it worth working with a financial advisor? I would say that kind of depends on how much you enjoy doing this stuff yourself. So I think you probably gather there's a lot of different areas in the laws and regulations, and income thresholds are constantly changing. So if you're somebody that enjoys kind of digging through the numbers, staying up to date, digging into how much your investment costs are in this fund versus the other fund, and you probably don't need an advisor if you're kind of doing all these things on a general level. But if you're somebody that just doesn't want to think about it, you're busy with work and family and whatever else, and you want to make sure that you're covered in all these different areas, and you kind of have a second set of eyes looking over everything you're doing to making sure that you're on the right path and you're saving enough for retirement, then maybe that is something you want to consider. And I just put this slide in to illustrate that there's ways that we can look at complex situations and kind of boil it down to a probability of success, which it may not be 100% accurate, but at least we're kind of putting hard data behind these numbers. So we're not making financial decisions by gut and saying, oh, I think you'll be fine. There's really hard data backing any recommendation an advisor would make if they're using some software like this. But then again, if you're an engineer and you're really savvy with Excel, you can probably do all this stuff on your own, but you'll spend a lot of time on it.
So I'll go ahead and open it up for questions. I have a couple of questions that came in here. How student loan debt might figure into kind of that scenario where you put in the debt to income ratio. So.
Sure. Yeah, that's definitely going to be something that you're going to want to use in like your overall calculation of how much debt you have relative to your income. And with student debt, I know it really runs the gamut where it can be pretty reasonably priced in some case in terms of being a reasonable interest rate, whereas it can be really higher interest rates in other areas. I've seen like 6% at times. So if you're in a place where your level of debt is probably a bit high for where you should be, then the strategy really is to kind of go after the highest cost of debt first. So if you've got a mortgage at 3%, you've got student debt at 5%, and a car loan at 7%, I would go after the car loan first, and just try to get the overall level of debt back down to a reasonable level, so much so that you can hopefully have some excess cash flow and begin saving money and doing things to accelerate your net worth going forward.
And one final question about when you work with a financial advisor, typically for someone who's starting out, who may not have a lot of investment, but who's starting out, typically, how does a financial advisor charge?
Yeah, so it's a number of different ways. I think some charge just a flat fee, and I think that's more on the rare side. Typically, how financial advisors charge is they get a certain percentage of the assets they manage on your behalf. And so if it's, they're managing $100,000. They would charge, just for example, a 1% fee. So they'd be getting, $1,000 per year. 1,000 is 1% of 100,000. So that's typically how most would do it. I think that a lot will have investment minimums, but I think if an advisor sees that like you're saving on a consistent basis and you have good financial habits, I think they're a lot more likely to work with you, even if you've just got $5,000 sitting in an account somewhere. If you're showing the willingness to want to try to grow and you've got stable income and you're doing all the right things systematically. So I hope that's helpful. Yeah, the model typically is a percentage of assets. That's kind of an industry standard. Probably around 1% is where that's going to fall for most advisors, kind of give or take a little bit, but that's typically how they do it.
And one last question about what to look for in a financial advisor. Can you talk a little bit about why people would pick one over another?
Yeah, sure, definitely. I think you definitely want to look at their experience and credentials, how long they've been in the industry. I think there's some really important designations out there, like CFA is a big one. A CFA is kind of like the highest designation you can get in finance. It's a really rigorous 3-year program, and the pass rate on it is very low. So I think that those letters CFA carry a lot of weight. And other than that, I mean, there's some due diligence things I would do. Like you can go to this website. It's called finra.org, FINRA.org, and you can do a broker check. So you always want to look up the advisor's name in there, make sure that they have no, fines or violations or kind of outstanding court cases against them. Do Google searches for the same thing. Just, make sure that they're, honest and honorable. They really, in the finance industry, they really don't allow you to do a whole lot of testimonials. They're heavily regulated, so you can't call them up and say, hey, can I talk to, 3 of your clients to evaluate you? Because it's going to be like a self-selection bias. You're going to pick your 3 best clients, basically. So there's that. I would say, experience, making sure they have a good track record, good educational background, and just, do you like them? Like, can you sit down? Can you feel like you can be honest around them? Do they give you the sense that they know what they're doing, and do they have a process? Do they have a plan? I think that's really important. Can they articulate their strategy clearly? And do they have a long-term track record? Just like for example, like at many firms, they'll have a performance record that goes back 20 years or something like that. So when they talk about their expected investment results, it's not just pulling numbers out of thin air. They actually have a track record they can point to. So that would be another big one too. And then finally, I was just asking what sort of software that they work with and use, because I think nowadays everybody is kind of in the tech field to some degree. You have to be able to use the latest and greatest software, and it's going to be a better client experience if the advisor is more tech savvy. So hopefully that helps.
Very good. Well, thank you so much for all those answers and for taking the time to present this to us. We really appreciate the organizations that have made this webinar possible. To our attendees, look for an email soon with a link to the replay of this event, and you're welcome to share that with friends or family or colleagues. And we will also publish that on our Advice Chaser website. Here at Advice Chaser, we're all about helping you find a financial advisor who's a good fit for you and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Goodbye, everyone.